Good afternoon then everyone, as we are at the start of another week of trading on Monday 8th of April. It's Mark again this afternoon, and yeah, let's get stuck into markets. Let's see what we're looking at and what seems to be ahead in the coming week, as we have pretty key US inflation data to keep us interested, certainly over the course of this week. We have a couple of central banks and stuff, but we will speak about them in a minute or two. Over the weekend, oil edges lower on Middle East ceasefire talks. These Middle East ceasefires are, talks about ceasefires in the Middle East never seem to really materialize, and they kind of keep going, and that continues to put pressure on oil prices. Supply difficulties in oil. There's a lot of Russian oil cargo trapped at sea. Venezuela are a large exporter of oil, and they seem to be next on the sanctions list from the US, which means people keep needing to use up the barrels of oil that are currently in circulation. So that continues to keep oil prices subdued, and oil popping up towards $90 a barrel, helping to steer commodity prices up towards the 2022 highs set back when Russia jumped into Ukraine. So it's likely to continue to put pressure on inflation, which brings us on to the inflation figures on Wednesday that we will get round to in a minute. This conflicting kind of, dollar yen's an interesting one. Dollar yen back up at that 152 level again. We'll look at that when we get around to some charts. But former Japan FX source says yen weakening could trigger intervention at any time. We had some Japanese people out over the course of last week saying that 155 is kind of the new level for intervention, or they would expect 155 to be the new level for intervention. So that 150, it'll be interesting to see if that breaks. Does it actually go and spark a bout of weakness in dollar yen, which is then strengthen the Japanese yen, or do they wait for that 155 level? You've got some differing opinions. Japan likely to intervene if yen falls well below 152, says DLR, says ex-FX diplomat Yamazaki. Again, another ex-FX diplomat said 155 last week. So that one, if yen falls well below 152, does fall well below 152 mean 155? And I say below, but we're talking about dollar yen, so we're kind of backwards when we're talking about the actual Japanese yen. So 152, 155, somewhere in that region. I would have said, the levels that we're at now, up at 152, that's a good price for a sell. You get a stop loss of 152.50 or 153. Look to try and hold the move in case we do get some intervention. It's a little bit more of a difficult trade from what they were saying. Last week. Dollar pauses ahead of US inflation data. We'll have a look at that US inflation data as and when we get to it. Yen nears 1990 lows. Again, Japanese yen multi-year lows, 1990 lows, we'll say. Obviously, that's what that market is telling us, or that report is telling us. I'm not gonna disagree with it. I don't know exactly where we're at in terms of history. All I know is we're at lows printed a long time ago, before I was born, if it was back in 1990. Apart from that, it's kind of where we're looking over the course of this week. We've got inflation to keep an eye on. We have oil prices we need to keep an eye on, which then in turn have effects on inflation. Treasury yields hit 4-month high as well. We'll have a look at Treasury yields when we get around to some charts, but main focus of attention is US inflation. And do we get much movement then off the back of it? European stocks being higher, and the DAX and Euro stocks just continue to trip their way higher, which is again, I've said a number of times over the last number of weeks and months that maybe it's a little bit of a difficult one to work out. But as I said, interest rates lower in Europe than they are the rest of the world, plus they're likely to cut sooner than the rest of the world. So that's probably the reason for them pushing higher. But stock index all being green, while yields are all green, and yields being driven off the back of interest rates moving higher, or certainly in terms of yields. The expectation is still for cuts. Does that bias change? I've been saying that for a while. Again, I'm not going to get into that in too much detail. You'll have seen in recent webinars, recent videos, my kind of opinions on that. I'm not going to go on a bit of a rant as of now, but your Aussie and your Kiwi up in line with stock indexes, which is not unsurprising. Your Japanese yen and your Swiss franc down in line with stock indexes or against stock indexes is not surprising. The rest of your currencies, the Canadian dollar, euro, sterling, relatively quiet start to the week. So not a great deal to see in the FX markets. We start the week, pretty choppy price action across FX markets. I mean, you have to imagine probably pretty choppy markets continue until we get a little bit later on in the week. You can see, your Aussie, Kiwi, Euro, and Sterling all pretty choppy to start the week. Dollar Swiss has been choppy for a week or so. Dollar CAD choppy to start the week. Dollar Yen's the one with some clear direction, rallying higher. We are back up towards that 151.90 level, or 152, we'll just call it. Still slightly below 152, but I kind of want the market. I want traders to push dollar yen above that 152 just to see what we might get. I mean, there's no point in me going back through kind of historical charts as we are at multi-year lows. But yeah, we had this bit of a rising wedge, didn't play out. Maybe that was something to look at up to that 152 level, but I can delete that because it hasn't panned out. But kind of between 152, 150. I can change. I mean, that is the resistance level up there. It'll be interesting to see what markets do with that level in today's session. Do we push away from it again? Do markets show reluctance to push price above there, or do we move lower off the back of that? You can see the last couple of times, like, markets were pretty quick to close out dollar yen longs up on Wednesday the 27th of March. Then back here we bounced off it there, pretty sharp shoot down, kind of 60 odd pips in an hour. In dollar yen, and a couple of days later you got again some more kind of forced liquidations Thursday of last week. Again, that kind of goes kind of similar times to some comments from some Fed officials, but kind of more probably closing out of dollar yen longs than anything to do with that, as that was kind of in the opposite direction. But yeah, I mean, that's an interesting move back up to 150.80, back up to 152 in the space of what, kind of 24 trading hours really, or 28 trading hours, something like that. Do we get back up above 152? It's definitely a chart to keep an eye on. Probably stick some sort of an alert up at 152, or just beyond. Equity markets, you can see equity markets, big sell-off Thursday of last week, in line with comments from Neil Kashkari, the Minneapolis Fed's chairman, suggesting that we may not even get a rate cut this year, which is exactly what I have been thinking. Markets haven't fully woken up to that, but we'll have a look at the CME's Fed Watch tool. See what they are pricing. I always do look at it every couple of days or so. Inflation figures on Wednesday will give us a bit of an idea. I think Japanese 10-year yield breaking 0.8% might be a catalyst. It's a fair point, Toby. Let's have a look at that. JP 10Y, I'll get on to that. Obviously, you can't really look at these markets or this markets and candlesticks as, it's a kind of pretty illiquid market. Obviously, when you look at that, the pricing isn't great for us. So we'll just turn it to a line chart, and you can see 0.8. Thursday of last week didn't quite get there, but we're certainly making an attempt at breaking up through that 0.8. Did manage to get above 0.8, nearly up towards 1%, kind of back end of last year, but certainly again, multi-year lows in the Japanese yen, multi-year highs in this. Now, if this continues to trend higher, certainly is broken above, yearly highs, or is trading at yearly highs, that's obviously pretty natural, considering the fact that they did remove their yield curve control from Japan. But I mean, the reason why the Japanese yen cannot strengthen is a lot got to do with this chart. I mean, you've got the 10-year yield on the Japanese yen at 0.8%. You look at where it's at in terms of the US 10-year yield is up at 4.5%. So US dollars or US debt still yield a lot higher than the Japanese yen. If you look at face value at the interest rates, 5.5% in the US and 0% in Japan. So they can go and raise interest rates all they want, but ultimately there's still a massive yield differential, which will need some repricing if that gap does close. But ultimately, we are not seeing at this moment in time much to suggest that the Fed are really going to cut interest rates anytime soon. Or certainly, my point of view, Jerome Powell seems to have a different point of view, but Who cares what he has to say? Faraz, what is yield curve control? Yield curve control is a tactic that central banks have in their arsenal, or weapon in their arsenal, in order to cool interest rates, right? We can get into bonds and be all kind of, kind of advanced with it if we want, but just a basic way of looking at yield curve control. Now, if you look at interest rates, right, the 10-year yield is the basis for a lot of loans in the US. Say if the US were to employ a yield curve control, for example, right, a lot of loans in the US are, or a lot of loans in the US are based off of the 10-year yield. So, you look at a lot of mortgages, things like mortgages, say if you're getting finance on a car, you're taking a loan for a bank for, I don't know, say a renovation in your house or something like that. That kind of goes in line with mortgage, but these type of things, right? Um, there's obviously loads of things that people will take loans for, but a lot of those loans that are handed out by the banks are based off of the interest rate that is on the 10-year yield. So they have a kind of fixed interest rate for the reasons that they have it, but a lot of loans are then based off of kind of a fluctuating interest rate, we'll say, from the 10-year yield. So, we'll know of bonds. If you purchase bonds, right, you can't trade the yield, or you buy the yield. If you purchase bonds, you get paid a certain yield, or a certain percentage of your investment, periodically throughout the time in which that you hold that bond, right? So if a government comes in and buys bonds, or if a central bank, sorry, comes in and buys bonds, what it does is it keeps interest rates lower, right? So if the Bank of Japan go in and buy government bonds, right, that pushes the yield on those government bonds down, which keeps loans throughout that country low, right? So a yield curve control is essentially the purchase of bonds in order to keep the yield on that bond down, which keeps interest rates down, right? And then it comes back to interest rates, where we know lower interest rates are there to spur economic growth. Higher interest rates there to stunt economic growth, again, to put it simply, right? So if the Bank of Japan go and purchase government bonds, it keeps the yield down, and then it keeps interest rates down, which means people can continue to loan money, right? So that lead to high inflation. It's supposed to. It didn't really happen in Japan, but Japan's economy has been pretty stagnant. So if you keep interest rates down, it's not that like lower interest rates lead to inflation, right? They do technically lead to inflation, but the reason why inflation goes higher is not due to the fact that interest rates are low, right? What interest rates being low, think about if you're going to take a loan off a bank, for example, right? You're going to borrow money from a bank, right? Would you rather borrow that money at a low interest rate, or would you rather borrow that money at a high interest rate, right? A couple of years ago, when it exactly low, right? Because a couple of years ago, interest rates were 0%. You're much more likely to go and borrow money from a bank when yields are at 0%, or when the interest rate is at 0%, rather than now where it's at 5.5%, right? So lower interest rates encourage people to borrow money. If people then borrow money, that is creating money, right? And that money can then be used across lots of different sectors of the economy. So when you have a look at it from that point of view, it's not the low interest rates themselves that cause high inflation. The lower interest rates boost economic growth because more people are likely to borrow money. That is more money being created, and then that gets used in the economy. Also, the more money that is created, right, if interest rates are lower, or if interest rates are lower, should I say, more money is created. If there's more supply of something, the price should go down, right? Price of the currency drops. Therefore, your purchasing power of this money or with this money is lower, and that technically leads to inflation as well. So yield curve control is designed to boost inflation because it's designed to boost economic growth. That's why it's supposed to happen. It didn't really work like that in Japan when they were doing it, but Japan are kind of a special case, and it has the pros and cons because the purchase of more bonds means that kind of the more debt in the country. So yeah, it's a little bit of a tricky one from time to time, but that's why Japan's debt to GDP, um, Japan's debt to GDP levels is the highest in the world. So the Japanese economy was so weak that even despite yield curve control, Japan didn't get high inflation. Yeah, it didn't have the effect that they wanted. There's lots of different reasons for that. I'm not going to get into them right now on this webinar. We can talk about them. I mean, I can prepare something if you want, and have a bit of a historical run through of Japan on another webinar if you would like, but yeah, that's essentially it. I mean, the Japanese economy is or hasn't been great for a long time. It wasn't great before that, and this didn't manage to fix it really. They've now got inflation back to a point in which they would want it, and then they can then remove that yield curve control, as kind of the more debt they take on, the more that can restrict the economy going forward. So there's pros and cons to it, like everything, but yeah, that's a kind of a brief example of it, if that makes sense. But yeah, I mean, the more that continues to rise, the more supportive it should be for the Japanese yen. But if global yields continue to rise, and the Japanese yields are just rising in line with global yields, then that is not really something that that strengthens the Japanese yen, because okay, it's positive for the Japanese yen, but it's also positive for all the other countries. So it doesn't really make or match up, should I say. Oil, bit of downside of the possibility of some ceasefire talks. Again, it's just talks, but you know, oil is still pretty firmly in an uptrend, so I'd still much rather buy that than I would sell it. You got a bit of a gap to fill as well. If you can't get up there, fill that gap. Certainly well on our way. We're back into it, and you'd expect that to be filled, and probably oil to make its way up towards $90 a barrel, maybe then 100 thereafter. Gold continues to rally. Right, gold continues to rally in line with yields. Well, if yields rise in line with inflation expectations, which it is at the moment, then gold continues to rally. But gold at fresh all-time highs, 23.40. When does that stop? Right, when does that stop? I think if the central bank, I mean, yields moving higher are supposed to be negative for gold, right? But if inflation expectations rise in line with yields, causes gold to then push higher, right? What you'll want is probably the Fed to come out and say they're not going to cut interest rates, which I think will happen at some point this year. I can't imagine. I personally don't think they'll cut this year unless inflation takes a turn for the worse, but it's going completely the opposite direction. Maybe that is actually taking a turn for the worse, but you know, commodity prices across the board continue to rise, and it's something I've been looking at a lot recently. Is Reuters commodity index. If I have a look at this, right, I mean, I can just put this back in a candlestick chart because the candlestick charts work, but this just continues to rally. You know, you're above these 2023 highs set back in September of last year, and you're up here sort of approaching these highs or making your way up to these highs that were set back when Russia invaded Ukraine. I mean, obviously you're a decent chunk away from it now, but I mean, that move there, commodity index, this is a basket of 17 commodities, not all specific commodities. There's some ETFs in here as well, but ultimately you can read this as a pretty good indication of how commodities are performing, and this just continues to rally higher. This is like a daily chart, so you only get end of day data or data on this one, right? And that continuing to rally, continues to put upwards pressure on inflation, and then that brings us back to inflation over the course of this week. You've got Wednesday, 10th of April this week, where you do have CPI. You also do have the Bank of Canada. We'll talk about that in a minute. But CPI, I mean, the expectations is for this to be below 0.4, back down to 0.3 on the 2-month over month figures. Core CPI expected to reduce by 0.1%. Total rate of inflation expected to rally, probably in line with those oil prices. So I mean, that is certainly a data release that gets extremely interesting if it beats consensus, right? I mean, Jerome Powell is still sitting there saying we're going to cut interest rates, or they're going to cut interest rates 3 times. Again, I've said it many times before, I cannot see it happening personally. And then the inflation prints are super important. I mean, if I go back to this, and again, I kind of always refer back to this thing across here. I mean, give it a second to load and look at where pricing is. If my thing wants to load again, 95% chance of no, we're not going to get a cut at the next meeting in May. It rules that one out. June, you can have a look at June. June is still pretty 50-50, right? There is still, let me have a look. There's a 51% chance of no interest rate cut by June, but again, this is changing, right? A month ago, there's a 26% chance of no cut. Then a week ago, there's a 42. A day ago, 46, which is obviously last Friday, and now 52%. Markets waking up to the fact that we're probably not going to get this cut in June. And if this inflation print comes in hot on Wednesday, that completely removes the possibility, I think. And yours is still at 51%. Yeah, I mean, I don't know, maybe refresh it or something, but that's a bit of a strange one that yours is still at 51%. But you can see across here 51.9%. I mean, this is completely then ruled out, I think, if we get a hot inflation print. That changed in the last hour. Refreshed it. Oh, nice. So yeah, I think it completely rules out the possibility of an interest rate cut in June, right? That then brings us into July, September, November, December, where there's then 4 meetings to do 3 interest rate cuts when economic data is still where it's at. Okay, they're saying they're wary of what not cutting interest rates could do for the economy, but ultimately at the end of the day, they need to, if inflation continues to rally, they haven't got a choice. It's the situation they put themselves in when they made a mess of monetary policy after COVID. Now they've got to deal with the after effects a few years later. So definitely no cut in May, probably no cut in June. Now, on the basis of this, a hot inflation print means definitely no cut in June. That brings us into July then. What they think about July, it's only a 31% chance of no interest rate cut from July. A month ago, that was only an 8% chance. Then it went to 28, now it's gone to 31, and that's likely to continue to rise. Again, pretty much a lot of this pricing will revolve around that April inflation print. And then, the way we're looking at this June interest rate meeting with this April inflation print will probably be how we're feeling about July's one when we get May's inflation print. Maybe the fact that this is the 31st of July, we'll still have June's inflation print plus another 6 or 7 weeks. So we also get June's inflation print just before this release, but they're not going to sit there and wait. They'll probably be like the day before we'll get that inflation print, and they're not going to wait to make the decision then. So yeah, I mean, 50-50 on interest rate cut by June. I'm personally not 50-50 at all. I'm 100% on no interest rate cut. That then again brings us back to inflation. So that is a super important inflation print, and probably like a straddleable event, right? If you have a clear directional bias on something, you kind of want to trade these things in that directional bias, maybe even take a position before the release. But ultimately, if you wanted to go and straddle it, if that either beats or misses consensus, you're likely to get a move either way, right? You've also got Chinese inflation that comes in on Thursday. It'd be interesting to see what that says, as obviously China being the second largest economy in the world. If inflation beats consensus there, we can have widespread effects across the economy, but we're not likely to see the follow through from the most recent inflation print, which was a full 1%. Expected to see minus 0.5% on that. So I say unfortunate. It's probably a good thing we're not getting the follow through. I say unfortunate in terms of us trying to make some cash from financial markets, but the Bank of Canada as well. I probably expect a more dovish response to the Bank of Canada. I can't remember off the top of my head what the last inflation print was in Canada. 0.3%. What's the consensus? Minus 0.6. We look at the year over year. Again, returning back is in 2.8. So it's 2 months in a row now that's been within their well, I do remember that now that I'm looking at it, but that's 2 consecutive months below the 3% target. Again, in the last interest rate decision, the Bank of Canada, right? Reason why I say potential for a dovish response on the Bank of Canada on Wednesday is in their last meeting. They said they did still. I can't remember the exact terminology that they used, but it was something along the lines of it is still premature to talk about interest rate cuts. The fact that you've had inflation back it within their 3% target range twice in the last 2 meetings, that kind of is a situation where they can at least open the door to talking about interest rate cuts. Economic data is not as strong in Canada as it is in, say, the US. That is a situation where, I mean, they also might want to keep the foot on the gas a little bit and still say it's too premature, just in order to not let inflation rise, because they do have rising oil prices, which can then influence it. So, it wouldn't surprise me at all if they did come across and kind of jawbone it a little bit to a certain extent. And it's not technically the correct term of jawboning, but I do kind of mean jawboning. And that will be well, it'll be something for us to think about. But if they do, the more probable outcome is probably for them to, or the more kind of, I said probable, the more, is it realistic, the word I'm looking for, in terms of what they should do, the fact that inflation is back within their 3% target, they probably should at least open the door to interest rate cuts somewhere. But I can understand if they don't want to do that, because of the way the commodities are heading and the way that inflation is going in other countries. But they kind of work off their own countries. They can't think what other countries are doing and then adjust their monetary policy in line with that. So probable outcome, dovish Bank of Canada, because they have both of their last two prints within the 3% target band. That would make sense, but I can also understand that if they do want to jawbone it a little bit and just get inflation a little bit more under control before going and cutting interest rates. We then on to the ECB on Thursday, 1:15 on 1:15 on Thursday. In terms of what to expect with the ECB on Thursday, again, we're still expecting wage data in May for the first quarter of this year before they want to go and make any adjustment to monetary policy. So same with their March meeting, right? Their March meeting was a bit of a non-event because they wanted to wait till their May meeting. I would suggest April, or I would suggest Thursday, which is obviously still, April is still before May, if you can't do simple mathematics. That would suggest to me that we are probably likely to see a bit of a non-event with the ECB. So I wouldn't lose sleep doing your analysis, trying to figure out tradable opportunities off the back of that. If they were to come out and suggest something like, they've seen say, they're going to have to talk about the wage data that they keep going on about in May, and we haven't had that yet, so they probably can just talk a bit August, talk a bit dovish, and then euro dollar probably meets back in the middle. So I'm not going to say, I'm trying to think of what to say, but I'll think of how to word it. But again, I'm not going to really do much analysis into that. It's probably a bit of a non-event, as they do want to wait for other data prints before going and making a decision on that. So yeah, probably a bit of a non-event when it comes to the ECB on Thursday. Right, there's a couple of other economic data prints out throughout the rest of the week, but that's kind of the major ones there on what to think about. Inflation out of the US, Bank of Canada, ECB. You also do have the RB&Z on Wednesday in terms of what to expect out of the RB&Z. The last meeting did open up the door to interest rate cuts, a sell-off in the RB&Z. Since then, we have a look at their inflation rate. You can see still is a little bit too high, up at 4.7 in Q4 of last year. You do not have their inflation prints out for Q1 of this year yet. They might have seen that data. They might have access to that data, or they probably should have. They will have access to that data themselves. Do they make a reference to it? Again, we don't know that information, so it's difficult for us to actually go and do any analysis into it. But they will open the door to interest rate cuts at some point. They do want to see a bit more progress on inflation. I can't imagine they fully open the door to cuts cuts too quickly. As you can see, inflation year over year, they still have more progress to make in terms of getting that under control. So ECB or B&Z maybe not the best focuses of attention this week. US inflation, then we get US PPI on Thursday, which we'll look at, and then the Bank of Canada and US inflation, probably better tradable announcements rather than the ECB and the RB&Z. That's my kind of thought process on this week. But we've got to keep an eye on those things. So any US related assets, then the Canadian dollar and commodity prices will be my main focus over the course of this week. Obviously, I'll update further as we get through the week. But anyways, yeah, that's kind of what I'm looking at. I think I'm going to wrap it up there then, folks. A bit of a rundown of the week. It's a bit of an idea for some things for yourselves to go off. Obviously, jump into your charts, see what you can find. Any questions, don't hesitate to ask. But anyways, have a good day, everyone, and I will speak to you all again tomorrow.